Hi guys, here's Arun with another recording, with another video about investments. So this video is very important as I'm discussing investment philosophy. We need to understand our philosophy towards investments before making any investments. Investments are risky business. Before you start putting your money aside for any sort of investments, you need to understand some basic investment philosophies. And these are very important. If you keep them in mind over long term, it ensures that you grow your portfolio. You do not lose your money, but you grow your portfolio. First of all, you need to know how well you tolerate investment risk. Your tolerance level of investment risk will determine how quickly you can grow your portfolio. Do not invest your money in some stocks that you're not aware of, you don't have any basic understanding of, like some exotic assets, private equity fund, hedge funds. Do not invest any money there, because if you do not have a high tolerance level for investment risk, it's the fear in your mind is going to ensure that you lose that money by coming out of your position as the position goes against you. Second thing, you need to build an appropriate asset allocation between stocks, bonds, and cash. These are the three asset categories that you need to allocate your funds between: stocks, bonds, and cash. Third thing that you need to keep in mind in order for you to grow your investment, that the more you spend to earn it, the less you will keep. In other words, choose funds or stocks where the cost of investment is very low. So your cost of investment should be low. In order for you to increase return on your investments, the cost of investment should be low. Fourth point, the best way to implement your plan is to invest in a low cost index fund. So other than investing stocks and bonds, you can also invest in low cost index funds. Low cost index funds, basically there's a very low management fees, and these funds have dividends coming from all sort of stocks, all sort of investments that they have under these funds. You get a part portion of each and every single share that you acquire through these funds. Fifth point that you need to keep that in mind, that there are three tools to deploy in the portfolio management process. First, which is asset allocation. Second is a market timing, and third, security selection. So asset allocation, like I mentioned before, stock, bond, and cash. Market timing, you can use dollar cost averaging. So if you're try to time the market, you're trying to wait for the market to go down and then put your money in, and but then you realize market went down further, don't put all your money at once. Don't put all your eggs in one basket either. So you select your assets, you allocate your funds accordingly, and then you do a dollar cost averaging. In addition to that, you need to do security selection. So if you are selecting some shares, don't just go because somebody told you this stock is a hot stock in the current market condition. You do your own due diligence. You study about the company, you read their post prospect, you read about the company and their future promises, what they have, and the future growth, what they're promising to investors. You need to do your own due diligence. Next point is you should start saving early. If you start saving early, you would have enough funds to invest. As much you can start saving, the maximum you start saving, you can put that money to work. So basically, saving is the first step for investment. You should start saving as soon as possible, start as quickly you can, and then start investing those funds. Also, you need to keep that in mind. Little by little, you can safely stock up a small result, but not until you start. So the first step is you start saving, and slowly, by adding your funds towards investments, buying more stocks and investing in other investment funds that you may have, and other stocks and bonds options, and keep some reserve, maybe some FDs, real estate, all sort of investments that you can invest in. But first step is to start saving. Then you need to also keep this in mind, the additional point: reduce your expenses well below your income. If you reduce your expenses well below your income, you will have enough cash in hand. That's called disposable income. Once you have a positive disposable income, this disposable income can be invested, can be put for investments, and this investment is going to bring you more money, which you can reinvest. Only sensible limit on a credit card is zero. So I would ask you to avoid credit card. Keep your credit card limits zero. Don't use them. If you use them, pay them as soon as possible. Don't pay high credit card fees and interest and expenses on those credit cards which you're using for your personal expense. Cut down on your expenses as soon as possible. Another point that I want to bring that to your attention is the miracle of compound interest. So the secret of getting rich is slowly but surely by the miracle of compound interest. That is the world's eighth wonder, compound interest. Once you know the game, all the rich people, they understand the compound effect. By compounding, your assets grow fast. But in order for you have to have some assets, some saving, and then over the period, you start reinvesting those, and the impact of compound interest is going to come into picture. The simple investment strategy is indexing. If you don't know which stock to pick, where to put your money, there are some risky stocks there, some risky assets, Bitcoin, gold, silver, real estate, and you're not sure where to invest your funds. It's better to invest in indexing, because indexing is a pool of investment basically for nation's best companies. Let's say S&P 500. These are the 500 best companies in America that you're putting money aside, and Dow 30. You're putting your money towards the larger 30 company in Dow, and NASDAQ, you have the company, 100 companies there. So you have the option to put your money in indexing. And also keep that in mind, nobody knows more than the market. So you try not to time the market. If you think the stocks are going to go down and you put all your money at that time, and then you realize, oh, this was not the right time, and the money went down, basically start losing money. And you're going to panic, and you're going to sell in panic. Basically, you'll be taking losses. So never try to time the market. Invest your funds over a period. Remember average cost, dollar cost averaging. So you put your money over a period. Do not invest everything in one time. You can also put your money in index nationally and internationally. So if you want to put your money in international funds, you can buy international index funds. You can buy index in US, you can buy index in European market, you can buy index in Asian market. There are a lot of markets available, Japanese market, Chinese market, as there are a lot of index and funds out there. Also, avoid funds with high management fees. You only invest in low cost funds. You do not invest in high management fees funds. They promise to beat the market, and the management fees are too high. You can find funds their management fees is less than 1/10%. Also, protect yourself by diversification. So don't put all your money in just one class of asset like stocks. You can have stocks, bonds, some cash, some gold, silver, land. You can diversify your portfolio. Diversify not only across securities, but also across asset class. So not just one company or 10 company stocks, but also you have different asset classes like gold and silver or land or Bitcoin, for matter of fact, and bonds. Across market, not just in America, you can have overseas index funds, international index funds, European, Asian. You can invest in those funds as well. And across time, try not to put all your money at once. You spread your money over a certain time period. You decide to invest 10% of your money at once, and over 10 months you will be able to invest 100% of your funds. By doing that, you will be investing at different times, whether the market is up or down. You're putting 10% of your money at once. Rebalance your portfolio in a timely manner, which will help you reduce your risk, and also it's going to make sure that you're not trying to beat the market. So rebalance your portfolio in timely manner. Also remember, you keep patience, be persistent with your strategies that you have for investments, and avoid some mistakes. Don't be greedy. Try not to overtrade. Don't overtrade. Try to keep your investment cost low. Don't listen to the market too much. Don't listen to the pundits where they come and say the stock's going to go down by 20%, stock's going to go up by 20% the next day when the news comes out. Avoid all this sort of chatters. Avoid forecast, all sort of forecast for economy or interest or stock market or interest rates, and minimize your investment cost. And remember, keep your investments simple. Do not invest in such exotic assets like private equity funds or hedge funds that you don't know, you're not aware of. Even cryptocurrency space, some people are not aware of that. So try not to invest your funds in something which you're not aware of, sound very exotic. It might be very lucrative, but at the same time very dangerous. So try not to put your money there. You can also invest in total world stock index by putting all money in a broader diversification in a single fund. And remember, adopt dollar cost averaging. I think this summarizes the whole investment philosophy that I think one should know before investing their funds. Because you work hard to earn that money, and if you want to put that money to work, you better have a better psychology, a better understanding, a psychological and philosophy about investments before putting your money to work. Once you have this set mind, basically, then you can grow your portfolio over time period. Put your money to work, keep your cost to the low level, don't go for crazy investments, try not to beat the market, have a rebalancing, and also invest in index. These are the best investment nowadays to keep your investment cost to a low level. I hope my video helps you, and if you like my video, please share with others, subscribe to my channel, and give a thumbs up.